after the budget, we do analysis of a finance bill. I'm not talking about analysis of budget. We are doing analysis of finance bill. And this always becomes necessary because when you see the big picture or a budget presentation on a screen or wherever you might and listen the speech of finance minister, you may get carried away. But by and large, the trade industry, or for that matter, even professionals, get affected by the fine prints in the finance bill. And the fine print, though available immediately after the presentation of a budget, it takes time to study the impact of that. This is Modi government's point 3 and Madam Sitaraman's 7th consecutive budget. The theme for budget was that there should be ease of doing business. Main thing. At the same time, I am not discussing any other welfare schemes developed in a presented in a budget. I am talking about the trade and industry. The theme was the trade and industry should be given a level playing field and should be given such an environment that there will be ease of doing business. We see every year that by and large, what has been stated in a budget speech, that there will be ease of doing business. When you see the fine prints of the budget, finance bill, you find that your life has become more complicated. And according to me, this year's budget or this year's finance bill is not an exception to what we have seen in the past. See, Vidarbha, small area, entrepreneurs, MSME, or at the most LSI or that level. Most of the industries are in a partnership, proprietary concern, etc. We have to analyze the provisions from that angle also. Certain direct tax proposals are certainly required to be looked into. And as I always tell, that the objective of this kind of session is to have a feedback and thereafter make an appropriate representation to the government on the certain provisions which we find are little bit not conducive to doing the business. Every year we do that kind of exercise. And in some of the cases, our proposals stands accepted also. Maybe it may be that other organizations are also making same kind of representation. Therefore, our representation would add to that representation. And from that point of view, this session is there. We are lucky enough today that we have 3 expert speakers to explain us the fine prints of the finance bill. In last 2-3 days, some discussions were going on and burning points which are emerging in last 3 days, possibly under the direct tax law, are 2. One is about the reduction of a rate on a capital gain from 20% to 12.5%. and simultaneously doing away the indexation benefit. If you do the close analysis, you will find that your taxation burden has gone thrice. With a 12.5%, whatever tax you would be paying without indexation, and the tax which you would have paid with indexation at the rate of 20%, possibly there is a difference, or it is 3 times more. That is one of the things you may notice. Second issue, which is again a practical difficulty, is in relation to TDS by a partnership firm. And on a remuneration, commission, etc., whatever they have paid to their partners, as allowable under Section 40B of the Income Tax Act. Now, practical difficulty is, by and large, this remuneration get crystallized or quantified maybe 10, 15 days ahead of date of filing of the return. And again, the calculation of a remuneration depends upon remuneration, more particularly commission part of that remuneration, is dependent upon finalization of a figure of a sales or finalization of a figure of a net profit of that entity. And therefore, you are not certain how much commission, interest, salary, etc. totally will be paid to the partner and how you will do the TDS on that. TDS is required to be done before 31st March. But this thing will get finalized somewhere in by 15th of September. So how you can anticipate and pay TDS on that, and if you pay short, again interest will be there. If you pay that more, possibly it will be difficult to get a refund of a TDS amount. That all things are there. Now, even in a private limited companies, also the same thing is being there. The reply to this would be possibly a large companies, listed companies maybe, where all this remuneration, etc., get finalized within a period of 1 month from the end of an year. Because they have to report their result to a stock exchange and everything is there. So they are in a position to do it. What about the small private limited companies or unlisted companies? Now, this provision, though not applicable to the listed companies, unlisted companies or private limited companies, my purpose of pointing out that is even those which are corporate entities having some kind of a good infrastructure, not in a position to compute the things, how it will be possible for a small partnership to compute. And top of that, the provision is that if you are paying any partner more than 20,000 rupees, you have to move the TDS. Now, if you consider a two-partner firm and 25,000 rupees each, possibly firm's turnover may not be more than 20 lakhs rupees. Can you imagine this firm having a turnover of 20 lakhs rupees will able to do this compliance? Earlier, TDS provision which was introduced on a partnership was limited to or confined to a partnership which are subject to tax audit. That means, to some extent, they were larger entities. Here it is a very small entity. How it is possible? This is two things which I just wanted to talk to you. Of course, in detail, the things will be explained to us by learned speakers. There are certain changes in the GST law also. But GST laws, there is nothing surprise. It was already made known by way of a GST Council decision, and the consequential amendments are there. But there are certain amendments which are again creating a problem which needs to be looked into. We'll understand in detail all the provisions from the learned speaker, and thereafter we will also seek your reaction on that. And possibly based upon that, we will submit our post-budget memorandum to the finance minister. Thank you very much.
Thank you, sir. I welcome Sri Nalin Chakodia, sir. Special welcome for him because first program after he attained post of vice presidentship in VI. Sir, congratulations. Sir, let's continue with the program. Uh, we will start with the indirect tax provisions first on subject matter of GST. I request Saurabh Gani shares to please take up the stage.
Uh, Good evening, all. So, thank you, Sachin sir and Ashok sir and Mukesh sir for the introduction. As uh, Ashok sir uh, said, there are no surprise amendments in GST. All these amendments were already decided by the GST councils, and they have been given effect to by the amendments in proposal in the finance bill. So the first major amendment in the finance bill is the introduction of 74A. So just to give a background, in GST there are two sections for creating demand, that is 73 and 74. The difference between section 73 and 74 was 73 74 was imposed in cases of fraud, suppression, willful misstatement with intention to evade taxes. In 73, it was without such intentions. 74, the time limit was 5 years from the due date of filing annual return or the date of LMS refund, and 73 had 3 years time limit. Similarly, the penalty provisions in 74 were higher, where it is 100%, and in 73 it was 10%. So, over the years, with our experience, what happened was that department had always misuse this process, section 74 provisions in cases where the time limit to demand your tax under 73 was expired. Suppose the 3 years has expired now, but the department has to raise a dispute on you. So they deliberately imposed 74 because now they have to raise the demand. This was the practice in the earlier excise also, which continued in GST also. So the what we understand the main purpose of introduction of 74A was to create a common timelines for both fraud and non-fraud cases. So now the section 74A as introduced is applicable for both fraud and non-fraud cases. It will be applicable for demands pertaining to financial year 2024-2025 onwards. The time limit prescribed for issuing the demand notices is 42 months. So notice is to be issued within 42 months of the date of furnished annual return or errors refund, and thereafter the order needs to be passed within 12 months, which is extendable by 6 months upon notification. The similarly the other provisions related